As 2025 comes to a close, it is tempting to think the story of the year is already settled. Tariffs, AI, volatility, a lot of noise. But markets really end a year quietly, and the final days of December often reveal more than the first 9 months combined. The closing sessions of this year gave us one of those moments. But before we get there, it is worth stepping back and asking a simple question. What actually drove returns in 2025? Because if you strip away the headlines, this was not a year of broad opportunity. It was a year of concentration, positioning, and misunderstanding. A handful of assets, sectors, and themes did almost all the heavy lifting. Many investors owned the same indices, similar funds, and same labels, yet experienced very different outcomes depending on what those vehicles were actually exposed to. This is where the confusion crept in. Diversification was talked about constantly in 2025, but it was rarely understood. Being spread across many holdings didn't mean being exposed to many sources of return. In reality, performance across markets were driven by narrow leadership. That was especially clear in the case of equities. Despite the attention it received, the US market didn't dominate 2025. In fact, the S&P 500 underperformed several other major regions, including the Europe and the UK. That alone challenges a lot of lazy assumptions. The story of 2025 was not of one market winning across the board. It was dispersion. Different regions performed well, but for very different reasons, driven by different sectors. Within the US, returns were highly concentrated. AI didn't lift the market evenly, it actually narrowed it. Capital didn't spread broadly, it clustered. A small group of tech companies absorbed a disproportionate share of attention and capital. As earnings came through and spending plans expanded, the market stopped asking whether AI mattered and started assuming that it was inevitable. But inevitability has consequences. Even in a year where the US index underperformed other regions, index outcomes within the US were still dominated by a small number of names. Concentration risk didn't disappear, it simply became easier to overlook. In 2025, AI was not a rising tide, it was a bit of a spotlight. If you were standing under it, parts of the year looked strong. If you weren't, returns were far less impressive. This is where people usually contrast the US with the UK, and often the conclusion is too simple. The UK market also experienced concentration in 2025 that is often overlooked, but the shape of that concentration matters. In the US, concentration was dominated by one sector and one idea: technology, AI, a small group of companies influencing outcomes disproportionately. But in the UK, concentration existed too, but it was spread across very different parts of the economy. So while both markets were concentrated, the risks they carried were not the same. The danger in 2025 was not concentration itself, in my view. It was pretending that all concentration behaves the same. That distinction helps explain why outcomes felt uneven, even though Europe and the UK outperformed the US overall. It also explains why diversification failed in different ways across different regions. At the same time, another story was building in the background, largely ignored for much of the year though: fear. Not panic, not crisis, but a steady accumulation of uncertainty. Concerns about the trade policy, government debt, currencies, geopolitical environment. Those concerns didn't express themselves loudly at first, they expressed themselves slowly, and then in the final week of the year, they became much harder to ignore. In the closing sessions of 2025, we saw a clear shift. Silver rose about 10% in a single session. Gold pushed to new all-time high. Platinum jumped around 10%. Palladium rose more than 14%. Silver was not reacting to a headline, it was responding to a structural deficit and rising industrial demand. Late in 2025, protection mattered more than prediction. That contrast is important. Earlier in the year, excitement dominated headlines. AI spending, earnings surprises, and thematic narratives captured attention. Later in the year, though, the tone shifted. The rally in precious metals was not about growth narratives, it was about trust, scarcity, and positioning. This is where many people misunderstood risk in 2025. Risk was not volatility, risk was not drawdowns, risk was not daily price movement either. In my view, risk was misunderstanding what you owned, why it was working, and what would happen if environment changed. Some assets took a lot of risk in 2025 for surprisingly little reward. Others quietly did their job without drawing attention to themselves. That difference matters. It also explains why long-dated government bonds, traditionally viewed as safe, became a source of anxiety again. Rising borrowing costs in places like Japan, the UK, and parts of Europe reminded investors that even familiar assets behave differently when supply and confidence shift. Capital flows to clarity, depth, and credibility, not just slogans. Which brings us to the real lesson of the year. 2025 didn't reward bravery, it didn't reward activity, it didn't reward confidence alone either. In my view, it rewarded understanding. Understanding where returns were actually coming from, understanding concentration risk, understanding the difference between excitement and protection, understanding that labels like global, diversified, or defensive don't mean much without looking underneath. And perhaps most importantly, it reminded investors of something that tends to get forgotten in loud markets. The year didn't end with a bang, it ended with a signal, a very important one, that markets don't shout when something matters, they whisper first. If you were listening in 2025, the message was quite consistent in my view. Positioning mattered, patience mattered, and humility mattered more than ever. If this video helps you better understand the investment landscape, please feel free to subscribe, and I'll see you in the next video. All the best.